Well, tensions rise in the Middle East. I want to bring in Joe Brusuelas. He is a principal and chief economist at RSM to talk to us about the economic impact, of course, mostly here at home, but how these events all impact it. Joe, thank you so much for joining.
Thank you. It's good to be here at the iconic New York Stock Exchange.
We're so happy to have you. And I actually want to start this morning with jobless claims because we got that data before the market opened. You and I were talking about it a little bit more than expected. What might this tell us about the labor market?
I think what it tells us is that job security for Americans is really at an all-time high. You know, the pace of firing, those initial claims have been remarkably stable now for a long period of time. But a little bit of seasonal noise that we always see in June and July that then backed off, right? So we overshot to the downside. It was 219 last week, it's 225 this week. Now, the 13-week moving average, which is how the pros on Wall Street look at jobless claims to smooth out that sort of noise, sitting around 235. So you can expect a modest migration upward in claims, but really that's about it. I think what's really important to remember too, the Boeing strike is not showing up in the claims data. Striking workers can't file for jobless claims, but those who are impacted, say in the aerospace ecosystem or the localities, they can. And we're just not seeing that quite yet. It gives you a good idea of just how resilient the American economy is at this time.
Interesting. And of course, this weekly jobless claims data that we get routine Thursday morning before the bell does come before that September jobs report that's out tomorrow morning. What are your expectations when it comes to the non-farm payroll report?
So we're expecting a net change in total employment of 120,000 with risk of a much more brisk print, a little bit stronger. 4.2% on the unemployment rate, 0.3% increase in average hourly earnings, which should translate to around a 3.7% overall year-over-year increase. So we think that this is what full employment looks like. You know, it's important to remember that when you're at full employment, we got an economy that's growing a little over 3%, I think, through the third quarter of the year.
Yep.
We've got productivity now really gaining some traction, 2.7% year over year. Firms just don't have to hire as many people, right? They're going to be more interested in controlling costs because as we can see, and we do expect in the third quarter earnings, which we'll be getting here in a couple of weeks.
That's right.
That you're going to see profits broaden out. It's not just going to be about tech. You're going to see the other sectors really begin to look a lot better, improve net earnings, improve revenues, improve profits. It's one of the reasons why I'm bullish on risk assets heading into the end of the year.
Interesting. And of course, for our viewers watching at home, those risk assets mean stocks, right?
Yeah,
here at the stock
yeah.
exchange. So I'm curious, Joe, based on what we see from the Fed, 0.5 percentage point interest rate cut at its latest meeting, mid-September, forecasting about the same before we get to the end of the year. Does this data indicate another 0.5 percentage point cut to you, or perhaps 2 quarter cuts before year end?
So Jay Powell last week gave a very interesting speech before the National Association of Business Economists. This data supports what Powell was pointing towards, which is not a 50 basis point cut, but a 25 basis point cut in November and then another one in December. So we will have seen a complete full 1% or 100 basis points decline in the federal funds rate between the time the Fed started their rate cutting campaign and the end of the year. You know, we've seen some very strong data. Now, last week, we saw upward revision of $294 billion to GDP. Let me put a framework around that. Essentially, we added somewhere between an entire Finland economy or Chilean economy to ours just over the past couple of years. And here's what's really important if you're managing portfolios. $800 billion in extra income was discovered, primarily in interest and dividends. What that means is there's a lot more cash out there. And it's, again, one of the reasons why, just from a very fundamental basis, I'm quite bullish. I think we had a constructive and encouraging outlook on risk assets. And I think once we get through the noise caused by what's going on in the Middle East, and hopefully we can get an equitable solution to the port worker strike, we're going to be in a very good position.
So let's talk about then what we do see unfolding in the Middle East and certainly some uncertainty impacting stocks this week. Believe it or not, speaking to the resilience, we've seen the markets hold up pretty well based on what's been unfolding there. Do you expect that could impact the U.S. economy?
Okay, so financial markets have been extremely well behaved during the first few days of this. Of course, there's a geopolitical risk premium attached to the price of oil. You're going to have Ian Bremmer on, who's fantastic, and he'll talk about, power politics and geonomics and how the intersection of that can spill over and had some adverse effects. But look, we had a lot of oil sloshing around the global economy. Chinese demand is diminished at best. And you know what? The U.S. economy is energy independent. We produce 13.2 to 13.3 million barrels per day. We expect that to increase over 14 million over the next 12 to 18 months. You've got other non-OPEC producers really increasing their overall supply. U.S. sits adjacent to Mexico and Canada, pretty notable oil producers. Moreover, we've seen an all-time high in the increase of production of natural gas, and we're diversifying away. We're developing renewables. Let me give you an example about that. I live in Austin, Texas. 2 years ago, my wife and I built a house, and she wanted a great big tall roof because it reminded her of what it looked like here at home on the Upper West Side. So, sure, right? My brother was like, "What are you doing? You're going to pay for this?" I'm like, "No. Half of energy in that part of Texas is produced by renewables. Energy is incredibly affordable because of that diversification." To make the long story short, even when we get those geopolitical disturbances out of the Middle East, the United States is far less exposed to it than it was 10 or even 20 years ago. And again, that's why you're seeing financial markets be so well behaved here.
Right. Those stocks still near record highs ahead of that jobs report tomorrow. So, Joe, I'm going to end. We just have about 30 seconds left in terms of what this strike means. What is its impact?
0.1% each week it goes on. 4.3 billion taken away. Lots of inventories were brought forward over the last 2 quarters. So there's enough inventory out there to get us through 2 to 4 weeks. We won't even see the economic impact of this probably for another 45 days.
Okay. Joe Brusuelas, thank you so much for joining. Appreciate it.
Thank you.
Here in our studio above the iconic trading floor.